Okay, let's unpack this. Welcome back to the deep dive. Today, we're looking at a company that, on the surface, makes one of the world's simplest products, the frozen French fry.
Right. But what our deep dive uncovered is that Lamb Weston, this giant in the fry world, is going through what we can only really call an existential identity crisis.
Absolutely. And our mission for this research was to answer one critical question, really for anyone watching the global food supply chain.
The question being, did all these recent operational failures permanently damage Lamb Weston's competitive moat, or is the stock price slump we're seeing just temporary panic?
We're trying to figure out if this company, this indispensable partner to fast food chains, has now become just an optional vendor.
It's a fundamental shift because
Yeah.
their job isn't just making food.
No, it's industrial logistics. They take a potato, which is a volatile, perishable thing, and they turn it into this perfectly consistent, high-margin frozen unit of profit.
They're a utility, a crucial utility for quick service restaurants or QSRs. They manage what is often the single highest margin item on the entire menu.
And to really get the crisis, you have to first understand the bedrock of the business, the strengths of the asset itself.
Exactly. We don't see them as just a food company. Our framing is that they are the global starch utility.
Strong frame.
Yeah.
But is it? Isn't there a risk of overstating it? What makes a potato processor a utility? Is there a physical reason?
There is. It all comes down to a concept our findings immediately zeroed in on, the Saudi Arabia of starch.
Okay, that's not corporate jargon. That's a real place.
It refers to a specific place, the Columbia Basin. It covers parts of Washington and Oregon, and it's a true geological anomaly.
What makes it so unique for growing potatoes?
You have this perfect combination. Rich volcanic soil. You have very long summer daylight hours because of the latitude, which means more photosynthesis.
More energy for the plant.
Right. And then the final piece is a consistent, managed water supply from the Columbia River. This combination basically insulates them from the weather risks that hammer other agricultural regions.
And the difference in productivity that our team found is it's staggering.
It is. This geography lets LW hit potato yields of around 600 hundredweight per acre.
And for anyone listening, hundredweight, or autota, is just the standard farm metric. It's how much potato you get out of an acre of land.
And that 600 number is the key.
Because it just blows away the competition. The U.S. Midwest average is, what, closer to 450?
450, and the European average is even lower, around 400. This isn't just a small edge, it's what makes them the lowest cost producer in the world, period.
So that physical moat is step one. How do they leverage that in the supply chain?
That's where they become this indispensable partner. They embed themselves so deeply into a QSR's operations that switching away becomes incredibly costly and difficult.
We saw some specific examples of this, like their stealth fry coating technology.
That's a great one. It's a proprietary starch coating that keeps fries crispy for longer.
Which is critical for delivery, right? For Uber Eats, DoorDash, all of that. If your brand is built on a specific crispy texture, you can't just switch to another supplier's fry.
You can't. And there's also a behavioral component we found, which we call the fry veto.
Ah, yes. The family dinner decision maker.
It's a real phenomenon. A child's preference for one specific fry, a McDonald's fry, a Wendy's fry can, literally dictate where an entire family eats. So fry quality isn't just a cost item, it's a strategic tool that drives traffic.
Okay, so this brings us to the really interesting part. Because you have this company with a permanent physical moat and this deep technological and behavioral moat. And then they commit what our report calls the cardinal sin for any logistics partner.
The crisis was triggered by one thing, the catastrophic rollout of their new enterprise resource planning system, the ERP. This happened in fiscal 2024.
And the ERP, just to be clear, is the company's brain. It's the central nervous system that runs everything from inventory to shipping.
Everything.
Yeah.
And when that system failed, they basically went blind.
Literally.
Literally. This is a company whose whole value proposition is reliability, the sleep well at night stock. And suddenly, they had no real-time visibility into their own inventory. They didn't know what they had, where it was, or how to ship it.
And this was a completely self-inflicted wound, a pure execution failure that cost them what, $135 million in lost sales?
That's the number, and the critical finding here is that this wasn't a demand problem. People were screaming for fries. This was an execution failure that turned Lamb Weston from a partner into a risk.
And that operational failure then created a management credibility crisis.
It did. At first, management was downplaying it, calling the ERP issues minor bumps in the road.
Assuring everyone it was a quick fix.
But what our research tracked was what we call a drip feed of bad news. Little bits of negative information coming out over months.
So now investors apply what we found is a credibility discount to anything management says. They just don't trust the guidance anymore.
And the immediate painful result of that was a donation of volume. QSRs can't risk having no fries.
Of course not. They run on just-in-time inventory.
So LW's most loyal customers were forced to immediately shift huge chunks of their contracts to competitors, mainly McCain and Simplot, just to keep their restaurants supplied.
And now LW is in this awful position of having to, quote, buy back the market share they just gave away. They have to offer price cuts to win back trust they lost because of their own mistake.
And this really sets the stage for the big structural headwinds they're facing now that their armor is cracked.
The industry has always been this cozy oligopoly. The Big Four control 97% of the North American market.
Which historically meant everyone could maintain rational pricing and keep margins high. But there's a key difference in ownership that's now working against Lamb Weston.
And this is such a critical finding. LW is the only major player that's publicly traded.
Exactly. McCain and Simplot, who together make up about half the market, are privately owned, family-controlled.
So they don't have to answer to Wall Street every 90 days.
They don't have that tyranny of the quarterly earnings call. McCain can play the long game. They can decide to do a land grab, go after LW's customers, and just absorb lower margins for a year or two to gain share.
They only have to answer to themselves. LW has to answer to thousands of shareholders if their margins dip for even one quarter. It's a huge structural disadvantage right now.
And on top of that internal pressure, you have this new European intrusion.
Right. Our research found that Agristo, a private Belgian company, is building a massive $450 million plant in North Dakota.
They're planting a flag right in the Big Four's backyard, adding a ton of new capacity right when LW is at its most vulnerable.
And it's not just in the U.S. The pressure is global. Europe had a massive potato crop in 2024, a bumper crop.
And when Europe has a glut, their processors start dumping. They export all that excess frozen inventory at cheap prices into international markets.
The Middle East, Asia.
Which forces Lamb Weston to cut its prices in those markets just to defend its share. It's a perfect illustration of the commodity cycle.
So excess rain in Belgium leads directly to margin compression for Lamb Weston in Idaho.
That's exactly it. And then you have the broader macro picture. The QSRs themselves are in this brutal value war.
All the $5 meal deals.
Right. Those deals drive traffic, but they crush the restaurant's margins. So the restaurant operator turns around and pushes their suppliers, like LW, for price cuts.
There's also a more subtle finding here, what we've called the fry shrink.
The mix shift, it's so important. When a customer buys a value meal, it almost always comes with a small fry, not a large one.
Which means less total tonnage sold per order.
Yes. And for a company like LW, that's a killer. They need their massive plants running at peak utilization 24/7 to be profitable. If every transaction has less product, their utilization drops and their per unit costs go up.
And we can't ignore the legal risk here, the ongoing antitrust lawsuits.
It's a tail risk, but it's real. There are active allegations that the Big Four acted as a potato cartel because of what the lawsuits call lockstep price increases in the past.
And just to be clear, we are just reporting on the finding that this exists as a regulatory risk.
It adds a layer of uncertainty. But despite all of this perfect storm of problems, our analysis also found some very significant qualitative tailwinds.
Which is why we think the asset is fundamentally undervalued. So what does this all mean for the long term?
Well, first you have to look at the resilience of the fry itself.
We use the lipstick effect analogy for this. In a downturn, people cut back on big things, like cars, but they still want small, low-cost indulgences.
A French fry is the perfect low-cost indulgence, and the per-calorie cost is almost impossible to beat. The fry attachment rate, the percentage of orders that include fries, is still incredibly high.
The volume will come back. The moat is still there.
It is, and they're not just sitting still. They're innovating with things like those delivery-proof coated fries we mentioned.
Which are higher-margin, value-added products. They're positioning themselves for the future of food service, which is delivery.
And then there's their international expansion. The huge new plants in China and Argentina, Right now, those are a drag on earnings because they're underutilized.
But our research views those as valuable call options.
That's the term. It's optional value for the future. They've already spent the money. Now they just hold the right to benefit immediately when middle-class consumption in those markets really starts to accelerate over the next decade.
And they even have a hedge against recession here at home, the private label pivot.
Right. If consumers trade down from eating at, say, McDonald's to just cooking frozen fries at home from the grocery store,
LW still wins.
they still win because they manufacture a lot of those private label store brands like Walmart's Great Value fries. It's a brilliant hedge.
And finally, the agricultural cycle itself looks like it's about to reset.
The early data our team is tracking for the 2025 crop suggests that farmers in North America are planting fewer acres of potatoes.
Which is exactly what you want to see if you're a processor.
A smaller crop is the natural cure for oversupply. It removes that excess inventory and gives processors pricing power again. It helps margins recover.
So when you put it all together, the permanent physical moat, the fact that the operational problem is actually fixable, these clear hedges, our final qualitative verdict on Lamb Weston is ACT.
The logic here is centered on a valuation disconnect. First, the asset itself, that Columbia Basin moat, is unique and it's permanent. It's immune to a software bug.
And second, the problem is fixable. The ERP issue is painful, but it's a finite event. Our data confirms their sell rates are normalizing, back up over 98%.
Right now, the market is pricing Lamb Weston as if this competitive damage is permanent, as if that lost volume is gone forever.
And we believe that's a massive overreaction. This is a classic good house in a bad neighborhood, but with a temporary broken window.
Our ACT verdict is really a bet on 3 different timelines all converging. The first is operational. The ERP fix is basically done. That's a matter of weeks and months.
The second is cyclical. The potato glut in Europe will normalize. That will probably take about 12 months.
And the third is structural. The whole fast food industry adjusts to the new consumer reality, and traffic stabilizes. That's more like 12 to 24 months.
And you're being paid a pretty decent 3.5% dividend to wait for those 3 things to happen.